Picture this notification hitting every phone in America at the exact same moment. Foreign nations accelerate historic exit from U.S. government debt as total federal borrowing crosses $39 trillion. Within seconds, the number starts trending everywhere. Comment sections fill with panic, and financial commentators who were talking about vacation plans an hour earlier are suddenly live on camera, trying to explain what is actually happening. This is not a distant hypothetical anymore. This is the world we are already living in, and the numbers behind it are almost too big for a normal person to picture. So let's make them real through the eyes of someone who has to live with the consequences. Meet Rachel Whitfield, 39 years old, owner of a small custom furniture manufacturing company just outside Charlotte, North Carolina. Rachel built her business from a single rented garage into a 22-person operation supplying boutique home stores across the Southeast. Like almost every small business owner in America, Rachel depends on credit. She has a variable rate business loan she used to buy new machinery, a line of credit she taps during slow seasons, and a mortgage on the small warehouse she finally purchased last year after nearly a decade of renting. On an ordinary Tuesday morning, Rachel is reviewing invoices when a news alert stops her mid-sip of coffee. Japan, long the largest foreign holder of United States government debt, has just posted its sharpest monthly reduction in Treasury holdings in years, cutting billions of dollars in exposure. China, already sitting on its lowest Treasury holdings in more than a decade, has quietly continued trimming its position as well. Together with several smaller nations following the same playbook, foreign governments have offloaded well over $100 billion in United States debt in a single month. Rachel does not fully understand bond markets, but she understands what happens next because her banker explained it to her once over coffee. When huge quantities of government bonds get sold off quickly, their prices fall, and because bond prices and interest yields move in opposite directions, those yields shoot upward. The benchmark 10-year Treasury yield, the number that quietly determines the cost of almost every loan in America, begins climbing toward levels not seen in more than a decade, brushing past 4.6% and threatening to push even higher. Rachel's variable rate loan is tied directly to indexes that track this exact number. Her banker calls that same afternoon with the kind of tone people use when they are about to deliver bad news gently. Her equipment loan payment is about to increase. Her line of credit is about to get more expensive. And the mortgage refinance she had been planning to lock in a better rate on her warehouse, the one that would have freed up thousands of dollars a month for new hires, no longer makes financial sense at these new numbers. This is happening to millions of Americans at once, not because of some isolated glitch, but because of a slow-moving structural shift that has been building for years and is now accelerating in plain sight. To understand why foreign governments are walking away from an asset that used to be considered the single safest investment on the planet, you have to understand what United States Treasury bonds actually are. For most of the last 80 years, the system worked beautifully. The United States could borrow cheaply because the whole world wanted to hold dollars and dollar-denominated assets, a privilege economists sometimes call exorbitant advantage. That advantage was built after the Second World War, when the dollar became the anchor of global trade, cemented further in the 1970s when oil-producing nations agreed to price crude oil in dollars, creating enormous structural demand for the currency that has lasted for 2 generations. But foundations built decades ago are now cracking under weight nobody fully anticipated. Total United States federal debt has now soared past $39 trillion, a figure that grew from $37 trillion to $38 trillion in a matter of months and has kept climbing since. Interest payments alone on this debt have surged toward roughly $1 trillion every single year, meaning the government now spends more servicing old debt than it spends on entire categories of national priorities. Every additional percentage point added to average borrowing costs translates into trillions of dollars in extra interest payments over the coming decade, a mathematical trap that gets harder to escape the longer it continues. Foreign governments watching this unfold are not panicking randomly. They are responding rationally to a changing risk picture, and many are quietly building an exit plan that has been years in the making. This is where the story shifts from Rachel's kitchen table in North Carolina to finance ministries and central bank vaults on the other side of the world. Nations that once considered American debt the ultimate safe haven have spent the last several years diversifying away from that dependency, and the shift has a name economists use constantly now: de-dollarization. Russia and China now settle roughly 90% of their bilateral trade without touching the dollar at all, using their own currencies directly. Payment systems built specifically to bypass traditional dollar clearing networks, with names like BRICS Pay and cross-border digital settlement platforms connecting central banks in Asia and the Middle East, are quietly processing more transactions every quarter. A coalition of major emerging economies, representing a substantial share of global economic output measured by purchasing power, has been coordinating on alternative settlement mechanisms, local currency trade agreements, and even a gold-backed unit of account designed explicitly to reduce reliance on a single dominant currency controlled by one government. None of this means the dollar is collapsing overnight, and any honest analysis has to say that clearly. because the dollar still represents a majority of global reserves and remains deeply embedded in trade, banking, and financial infrastructure everywhere. But the direction of travel matters enormously, and the direction has been consistently one way for years, with the dollar's share of global reserves sliding from roughly 3/4 2 decades ago to closer to half today. And nowhere is that shift more visible than in the astonishing appetite central banks now have for physical gold. Survey after survey of the world's reserve managers now shows the overwhelming majority expecting their institutions to keep adding gold to their vaults over the coming year, with the percentage planning to actively increase their own holdings hitting the highest level ever recorded in these surveys. Central banks purchased gold at a pace during recent years that dwarfs anything seen since the era of fixed exchange rates, buying roughly double the annual tonnage they used to buy just a decade earlier. Gold has reportedly overtaken United States government bonds as the most widely held reserve asset among some central banking authorities for the first time in generations. A symbolic milestone that would have sounded absurd to describe just a few years ago. Analysts at major investment banks now openly discuss gold prices climbing toward historic new highs, driven substantially by this relentless official sector buying rather than retail speculation. Why does a shiny metal with no yield suddenly matter so much to sophisticated institutions that used to prefer interest-bearing government bonds? Because gold cannot be frozen by a foreign government, cannot be sanctioned, cannot be devalued through someone else's monetary policy decisions, and carries no counterparty risk whatsoever. After watching certain nations have hundreds of billions of dollars in reserves frozen or restricted following geopolitical conflicts, reserve managers everywhere absorbed an uncomfortable lesson. Holding your national savings in another country's currency means trusting that country's government indefinitely, and trust, once shaken, is very hard to fully rebuild. Back in Charlotte, Rachel does not follow any of this news about gold reserves or payment systems. She is simply trying to figure out how to keep her business afloat while her costs rise. Her story is playing out in parallel across the country in ways most people do not connect back to a bond market they have never thought much about. A young couple in Ohio watching their mortgage pre-approval shrink as rates edge higher. A retiree in Arizona nervously checking a brokerage account as bond-heavy portfolios wobble. An auto dealer in Michigan watching financing offers become less attractive as loan rates creep upward alongside the benchmark yield. A city government somewhere in the Midwest quietly reconsidering an infrastructure bond issuance because borrowing costs have become noticeably less favorable than they were 18 months earlier. This is the hidden architecture connecting a bond auction in Washington to a kitchen table conversation about whether a family can still afford the house they wanted to buy this spring. Meanwhile, on trading floors in New York, London, and Tokyo, professional bond traders are watching this unfold with a mixture of fascination and genuine unease. Consider someone like David Park, a fixed income portfolio manager who has spent 15 years buying and selling government debt for a mid-sized investment firm. David has lived through market stress before, but he describes this moment differently to colleagues, not as a single dramatic crash, but as a slow structural repricing that keeps grinding forward month after month. He watches auction data every time the Treasury sells new debt, paying close attention to something called the bid-to-cover ratio, which measures how much demand shows up relative to how much debt is being sold. When that ratio weakens, it signals buyers are becoming pickier, demanding higher yields to be enticed into purchasing, and multiple recent auctions have shown exactly this kind of softening demand, forcing the government to offer more attractive terms just to get the debt sold. David explains to younger analysts on his team that this is precisely how these episodes tend to unfold in the real world, not as one single headline event where every country dumps every bond simultaneously, but as a persistent grinding erosion of demand that pushes yields higher gradually until the cumulative effect becomes impossible to ignore. And the effects compound in ways that feed back on themselves. Higher yields mean the government has to pay more interest on both new debt and existing debt as older, cheaper bonds mature and get refinanced at today's higher rates. That growing interest burden widens the budget deficit further, which means the government has to issue even more new debt to cover the gap, which puts even more supply into a market where demand is already softening, which can push yields higher still. Economists have a specific term for the danger zone at the far end of this spiral: fiscal dominance, a scenario where the sheer size of government financing needs starts to override normal monetary policy, potentially forcing a central bank to step in and buy debt directly just to keep markets functioning, a move that risks stoking the very inflation everyone is trying to avoid. Former senior Treasury officials have publicly acknowledged that the warning signs pointing toward this kind of dynamic have been strengthening, a remarkably blunt admission from people who spent careers reassuring markets rather than alarming them. Now layer in a second pressure that has been compounding everything simultaneously: geopolitical conflict driving energy prices sharply higher and reigniting inflation that policymakers thought they had mostly tamed. Recent flare-ups in the Middle East disrupted crucial oil shipping routes. sending gasoline prices surging by double-digit percentages within weeks and pushing headline inflation readings back up toward levels not seen in years. Inflation and rising bond yields feed each other in an uncomfortable loop, because investors demand higher compensation to lend money when they fear their eventual repayment will buy less than it does today, which means yields climb higher whenever inflation fears intensify, which then makes borrowing even more expensive for governments, businesses, and families all at once. The Federal Reserve finds itself caught in an unusually difficult position, wanting to cut interest rates to support a cooling job market and slower growth, while inflation running hotter than the target gives policymakers reason for caution, resulting in unusually contentious votes among Fed officials that reveal genuine disagreement at the highest levels about which risk deserves more weight right now. For Rachel, none of this abstract policy debate matters as much as the number on her next loan statement, but understanding the machinery behind that number helps explain why it feels so disconnected from anything happening inside her own business. She did nothing wrong. She did not overextend, did not take excessive risk, did not make a single bad decision that a competent banker would have flagged. She simply exists inside a financial system where her borrowing costs are quietly tethered to decisions being made in finance ministries thousands of miles away. Decisions about reserve diversification, gold accumulation, and geopolitical risk management that have absolutely nothing to do with furniture manufacturing in North Carolina, yet somehow determine whether she can afford to hire 2 more employees this year. This is the part of the story financial news often skips past too quickly. The human translation layer between macroeconomic headlines and dinner table decisions. When mortgage rates track the 10-year Treasury yield the way they consistently have for decades, every basis point increase ripples outward into home affordability calculations for millions of families simultaneously. When corporate borrowing costs rise alongside government yields, businesses delay expansion plans, postpone hiring, and sometimes cancel projects that would have created jobs. When cities and states face higher costs to borrow for infrastructure, road repairs get delayed, school construction gets pushed back, and public projects that communities were counting on quietly slip further into the future. None of these individual consequences make headlines on their own. They simply accumulate quietly across millions of households and thousands of institutions until, in aggregate, an entire economy has shifted noticeably slower and more expensive than it was just a couple years earlier, without any single dramatic moment anyone can point to as the definitive turning point. So does this mean collapse is inevitable? That the dollar is finished? That American financial dominance is simply over? The honest answer, the one serious economists across the political spectrum actually agree on, even when their politics diverge sharply on almost everything else, is more nuanced than either extreme. The United States dollar still underpins the overwhelming majority of global trade invoicing, still represents the largest share of global reserves by a wide margin, still trades in markets deeper and more liquid than any alternative currency on Earth, and still benefits from institutional depth, rule of law, and financial infrastructure that took generations to build and cannot be replicated overnight by any rival system, however ambitious. The euro has grown its international role modestly and steadily. Gold has clearly reclaimed prominence as a reserve asset, and alternative payment networks are expanding their reach year over year. Yet none of these alternatives currently offers the combination of liquidity, trust, legal predictability, and sheer market depth that the dollar system still provides, which is precisely why total collapse scenarios, however viral they go on social media, tend to overstate the speed at which any of this can realistically unfold. What is genuinely happening, and what Rachel is genuinely feeling in her monthly loan statements, is not a cliff edge, but a gradual repricing of risk, a slow renegotiation of terms between the United States government and the rest of the world about exactly how much of a premium lenders now require to keep financing an ever-growing pile of debt. That renegotiation shows up as higher average borrowing costs across the entire economy, as central banks quietly diversifying reserves toward gold and other currencies without abandoning the dollar altogether, as foreign governments trimming Treasury exposure at the margins rather than dumping it wholesale, and as ordinary households and business owners absorbing the cumulative weight of decisions made in rooms they will never sit in. Rachel eventually adapts, because small business owners generally have to. She renegotiates payment terms with her suppliers, delays the warehouse refinance until conditions improve, and puts her expansion plans on a slower, more cautious timeline than she originally hoped for. She is not wiped out, her business does not collapse, but her margin for error has shrunk considerably, and that shrinking margin is happening simultaneously across millions of households and businesses that collectively make up the engine of the American economy. Meanwhile, policymakers in Washington face their own version of Rachel's dilemma at a vastly larger scale, needing to convince the world that American debt remains a trustworthy place to park capital, while government spending continues to outpace revenue year after year with no serious near-term plan to close that gap meaningfully. Every auction of new government debt becomes a small referendum on that credibility, And while most auctions still succeed in finding buyers, the terms buyers demand keep quietly ratcheting upward, a slow motion vote of diminishing confidence playing out in real time in markets most people never watch directly. If this trend continues unaddressed for years rather than months, the consequences compound in ways that become progressively harder to reverse. More of the federal budget consumed by interest payments rather than services, less flexibility to respond to the next genuine emergency, whether a pandemic, a war, or a financial crisis, and a steadily eroding version of the exceptional borrowing privilege the United States has enjoyed since the end of the Second World War. Yet history also offers a genuinely important counterpoint that deserves equal weight in this story, because economies and currencies have weathered serious confidence crises before and adapted, rather than collapsed entirely. The 1970s brought a dramatic and unplanned break from the gold standard that many predicted would destroy the dollar's global standing permanently. Yet the dollar adapted, evolved, and remained dominant for another half-century afterward. Markets have absorbed credit rating downgrades, absorbed debt ceiling standoffs that came within days of technical default, absorbed banking crises and pandemic shutdowns, and while each episode caused real pain and real volatility, none produced the total systemic collapse that the most dramatic predictions warned about at the time. The lesson embedded in that pattern is not complacency. Real risks deserve real attention and real policy responses, but it is also not the kind of apocalyptic inevitability that generates the most viral headlines and the most alarmed comment sections. What actually determines which path a nation walks down, gradual painful adjustment or genuine crisis, tends to be less about any single number on a balance sheet and more about whether the underlying economy keeps producing enough real value, innovation, and productivity to justify the confidence the rest of the world continues extending toward it. Rachel's furniture business, multiplied by millions of similar businesses across every state and every industry, represents exactly that underlying productive capacity that ultimately backs every dollar and every Treasury bond ever issued, more fundamentally than any number printed on a government ledger. As long as that productive engine keeps running, keeps innovating, keeps generating goods and services the rest of the world wants to buy, the argument for maintaining confidence in the system remains genuinely strong, even amid a period of uncomfortable adjustment like the one unfolding right now. The nations reducing their Treasury holdings and buying more gold are not necessarily betting on imminent American collapse. In most cases, they are simply doing what any prudent household or institution does when a single asset starts to look overly concentrated and slightly riskier than it used to, diversifying sensibly rather than abandoning the relationship entirely. That distinction matters enormously for how ordinary people should interpret headlines about foreign nations dumping American debt, because the difference between prudent diversification at the margins and a coordinated total exit represents the difference between a manageable multi-year adjustment and an actual full-blown financial catastrophe. And the evidence overwhelmingly points toward the former scenario rather than the latter, at least for now. Rachel eventually finds a strange kind of peace with her new financial reality, not because the higher costs stopped hurting, but because she came to understand the way David the bond trader understood, and the way finance ministers negotiating trade settlements around the world understood, that this entire system runs on a resource far more fragile and far more valuable than any bond, currency, or ounce of gold. And that resource is simply trust. Trust between governments and the people who lend to them, trust between central banks deciding where to park a nation's savings, trust between a small business owner and a bank willing to extend credit for one more year, and trust that tomorrow's economy will still be productive enough to honor the promises made today. When that trust gets stretched, markets react exactly the way they have been reacting, with rising yields, rising borrowing costs, and a steady rebalancing of who holds what and why. When that trust eventually stabilizes, as it generally has throughout modern economic history even after serious scares, borrowing costs settle into a new normal, businesses like Rachel's adjust and keep operating, and the system, bruised but intact, keeps moving forward into whatever comes next. There's another angle to this story that rarely makes it into viral finance videos. The view from inside a reserve management office on the other side of the planet, because the decision to sell Treasury bonds or buy gold instead is never made casually or emotionally. It is made by careful, cautious professionals whose entire job is protecting. Consider someone like Mei Ling, a fictional but entirely representative reserve manager working inside a Southeast Asian central bank, someone who spends her days modeling currency exposure, running stress tests, and presenting quarterly recommendations to a reserve committee that answers ultimately to her nation's finance minister. Mei Ling did not wake up one morning and decide to abandon the dollar. Her institution still holds a substantial majority of its reserves in dollar-denominated assets, and almost certainly will for years to come, because the alternatives, however much they are growing, still cannot absorb the sheer scale of capital her country needs to park somewhere safe and liquid. What changed for Mei Ling and thousands of reserve managers like her across dozens of countries is the calculus around concentration risk. A decade ago, holding the overwhelming majority of national reserves in a single currency and a single government's debt felt like the obviously prudent choice, the closest thing to a risk-free position available anywhere in the world. Today, after watching sanctions freeze hundreds of billions of dollars in reserves belonging to another nation almost overnight, after watching the country issuing the world's reserve currency run deficits that show no credible path towards stabilizing debt as a share of its economy, and after watching gold quietly outperform bonds during exactly the kind of geopolitical stress episodes her stress tests are designed to prepare for, Mei Ling's recommendation to her committee has shifted incrementally year after year. Trim the Treasury position slightly, add another percentage point of gold, explore settlement arrangements in regional currencies for trade that used to route through dollars by default. Multiply. Mei Ling's incremental, cautious, thoroughly unglamorous decision by dozens of similar reserve managers, making similar calculations in similar meetings across Asia, the Middle East, Latin America, and Eastern Europe. And you get exactly the pattern showing up in the data, not a stampede, not a coordinated conspiracy, but a slow, steady, broadly synchronized drift away from concentration and toward diversification, driven by risk management logic that any prudent institution would recognize instantly. Back home, this same dynamic is quietly reshaping retirement accounts belonging to people who have never heard of Mei Ling or thought about foreign reserve management even once in their lives. Consider a retired teacher named Harold, 68 years old, living outside Phoenix, Arizona, who spent 30 years building a retirement portfolio balanced between stocks and what his financial advisor always called the safe portion, a mix of government and high-quality corporate bonds meant to provide stability as he aged. When Treasury yields climb rapidly, existing bonds that pay lower fixed rates become less attractive compared to newly issued bonds paying more, which means the market price of Harold's older bonds falls, even though he has done absolutely nothing wrong and made no risky decisions whatsoever. Harold checks his account one afternoon and sees the supposedly safe portion of his portfolio down several percentage points, a paper loss that feels deeply unfair given that he specifically chose bonds to avoid this kind of volatility in the first place. His advisor explains patiently that if he holds those bonds to maturity, he will still receive the full face value back. The paper loss only matters if he needs to sell early. But the psychological impact of watching your safety net wobble during retirement is real, regardless of what the spreadsheet technically says. And Harold is far from alone, because pension funds, insurance companies, and millions of individual retirement accounts across the country are absorbing the exact same repricing simultaneously, a quiet, widely distributed cost that never generates a single dramatic headline but adds up to a genuinely significant transfer of wealth away from savers and toward whoever benefits from higher prevailing interest rates. The stock market feels its own version of this pressure too, because when investors can suddenly earn meaningfully more from a supposedly risk-free government bond, the calculation for how much they are willing to pay for riskier stocks shifts accordingly. And sectors that depend heavily on cheap, long-term borrowing, technology companies investing in future growth, real estate developers financing new construction, and highly leveraged corporations refinancing existing debt tend to feel the pinch first and hardest whenever yields climb quickly. None of this happens in isolation. Each piece connects to every other piece. Rachel's business loan, Mei Ling's reserve allocation memo, Harold's retirement statement, and David's trading screen in New York are all ultimately reading different instruments measuring the exact same underlying phenomenon: the price the world is willing to charge the United States government to keep lending it money. And that price has been climbing for reasons that are structural rather than temporary, which means the adjustment period is likely to stretch on for years rather than resolve itself quickly through any single policy announcement or emergency intervention. The real question worth asking is not whether some single dramatic headline moment of total collapse is coming, because the evidence suggests the far more likely path is this same gradual grinding adjustment continuing for years, but whether the underlying decisions being made in Washington about spending, borrowing, and long-term fiscal discipline will eventually restore enough confidence to slow this drift, or whether the drift continues accelerating until it forces a far more painful reckoning down the road. And that outcome, unlike so much of what happens in global bond markets, actually remains within the control of policymakers still writing this story one decision at a time. If lawmakers eventually find the political will to narrow the gap between what the government spends and what it collects, even gradually rather than all at once, the pressure pushing yields higher would ease correspondingly, foreign buyers would likely regain some of the confidence they have been quietly shedding, and Rachel would eventually see her loan costs stabilize rather than keep climbing. If, instead, deficits keep widening indefinitely regardless of which party holds power, the drift documented in this story keeps compounding. Foreign holdings keep declining at the margins. Gold keeps climbing as the preferred alternative reserve asset, and ordinary households keep absorbing a slow, steady tax in the form of higher borrowing costs that never technically appears on any government ledger as a tax at all. Either way, the story unfolding right now inside bond markets, central bank vaults, and small business loan applications across the country is not really a story about numbers on a screen. It is a story about whether trust, once quietly eroded over years of accumulating debt, can be rebuilt through disciplined choices, or whether it continues drifting away, one auction, one downgrade, one reserve committee memo at a time. And the answer to that question will shape the cost of borrowing, the size of retirement accounts, and the price of buying a home for an entire generation of Americans who never once thought a bond auction in Washington could possibly matter to their own kitchen table.